Good morning and welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts, and talking a little bit about where we are on a couple of different fronts in this weekend's newsletter at the website now, realinvestmentadvice.com. You can get our latest newsletter there simply by clicking the newsletter link. There's a couple of issues I'd like to readdress with you this morning as well. One is the S&P 500 here. Last week, the markets tried multiple times to set new highs, failed to do that, struggling to really kind of maintain this altitude at the moment. And again, the deviation between the S&P 500 and the 200-day moving average is fairly extended here. Typically, that leads to a correction, at least in the short term. At the same time, our money flow indicator is starting to deteriorate. Now, the money flow indicator has not turned to a sell signal yet, but it is beginning to slightly deteriorate. Normally, when these deteriorations begin, they do complete the cycle. As you'll notice going back, it's a regular ebb and flow of money flows into markets, which dictate really of markets advance or decline. So the deterioration in money flow suggests that the markets are getting weaker here, and we're likely to see a correction here over the next 2 to 4 weeks. Now, again, doesn't mean a major correction, but as we discussed in the newsletter, a 5 to 10% correction in the markets is absolutely normal within the context of any given year. So a 5 to 10% correction from here would be absolutely norm. Unfortunately, since most investors have forgotten what a decline like that feels like, it'll actually feel much worse than it is. The other topic that we discussed this weekend was also the U.S. dollar. The U.S. dollar has gotten to an extreme net short position on a lot of different fronts, which typically leads to a rally in the dollar. And the dollar has been kind of building out a bottom here short term. Again, we got a money flow buy signal on the dollar currently, but it's getting fairly extended here. But money flows just turned positive on the dollar. So that does suggest here that over the next week or so, we could see a counter trend rally in the dollar. This weekend, I tweeted out a note on this particular point, and I'm not talking about a rally in the dollar that goes back to all-time highs. I'm simply talking about a reflexive bounce here. Now, that reflexive bounce in the dollar would also lead potentially to a sell-off in commodities like gold, oil, and even the stock market would coincide with a correction in the stock market as money came out of risk and flowed into areas of safety, which would be the U.S. dollar and Treasury bonds. Treasury bonds also have gotten very oversold here on a very deep money flow sell signal, and if that begins to turn up positive here, we're likely going to see a rally back in bonds. Again, that would also coincide with a sell-off in the markets and a rally in the dollar. So there are just some things that are set up here currently that you want to pay attention to. Again, we want to maintain our long positions in the equity market right now simply because that's where momentum is. And again, we're hedging that risk with positions in fixed income and the U.S. dollar temporarily, as some of the correlations still exist. If you have any questions, get by the website, realinvestmentadvice.com. Let us know what we can do to help you out. Realinvestmentadvice.com. Get our latest newsletter. We go through all of this and more at the website, realinvestmentadvice.com. We'll see you next time.